Well, good afternoon, Maverick traders. Joe with you here on a Wednesday. It's the 12th of March. Let's get into a market roundup. I'm going to talk about the meaningful news of the day, look at some things technically, and if I've got some trades to share, you know I will.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
As we move into the market analysis for today, folks, we got kind of a bounce. It was a pretty interesting one. Let's get straight into the daily news. So another volatile day in the markets as they continue to kind of search for technical relief. We've been pretty much free falling for quite a bit, but we know that the markets are going to find an area where there are going to be some short cover rallies. We're going to see some bottom fishing, just some kind of a hesitation. And we know we're getting kind of close. Now, I'm going to add to what Rob was talking about yesterday in that it's more of an area than a specific bounce. This could be tested once or twice. So a pretty good bounce up and then a gap down, gap up, gap down. But it will maybe establish itself. Overall, folks, we should follow trend. So the CPI lower than expected for February, showing that inflation is cooling. But nowadays, it's a little bit more than that, isn't it? So it was a 0.3 expectation. It came in at 0.2. All of a sudden, is this slowdown too aggressive or is it right in line? It's a very difficult thing to gauge. Now, the initial reaction was positive, but we went all the way back down and then we came back up to close flat. In fact, let's take a look at it. So the Dow was actually finished down 0.20, but look at the bounce in the Qs, 1.22%. Russell's up a little bit. And oil and gold. Well, oil had a pretty good bounce off of a bottom, and gold has been pretty stable. In fact, gold's probably been the most consistent, strongest thing out there over the last little bit. We'll talk about that here in a second. So it was a bounce overall. Let's take a look at the advanced decline line. 56% advancing, 41% declining. We do have the disparity, 73% below the 50-day moving average and 27% above. So it is definitely glass half empty. It is still bearish out there, and these bounces come hard and they come fast, and they come to the things that are hit the hardest. That's why I think the Qs had the largest move. Let's jump straight into the charts. This is the S&P, and what I'm talking about is this move. We're looking for some sort of a capitulation, some sort of a turnaround in volume, things like this. Now, this does look high. However, the reaction did gap. Understand, this is where we closed yesterday. We did gap higher and then kind of gave it all back and then climbed back up. So I would anticipate some sort of a retest in this region, meaning that we are probably going to get more of this type of a correction than we are of getting just a specific straight move to the upside. I think it's going to be pretty muddled, which means the support level that we're looking for might not be an exact area. It could be basically just more of a range. So we have to let the markets kind of stabilize. We have to let them kind of do what they want. And this was a pretty good bounce. I've got a couple things to look at here in a second. So let's take a look at the Qs. You could see that the Qs actually had a lot larger of a move to the upside. And you can see that the Dow actually, I don't have it up, but the Dow actually didn't quite make it to the positive side. But take a look at where this closed and where it opened. It did have that same shadow up and down, but it closed substantially higher. It's a lot more volatile. It does have some of those larger companies that can skew it one way or the other, but it's in the exact same situation. So it could be the beginning of an area that the markets might try to find some traction. Now that can change based on policy. Of course, we've seen that quite a bit. And folks, we're still in earnings season. But with today's CPI number, I expected a little bit more positive out of the S&P than what I saw. Let's get to the heat map. There it is. It's the push and pull. Apple, consumer drops pretty bad. Microsoft, but NVIDIA had a great bounce. So I'm just going to do this real quick, folks, because I've got a slide that I built. Let me see if I can get another box here. So take a look at what technology, software did, communications, services, and cyclical. Then take a look at the consumer defensive. It's red, healthcare, utilities. But I am going to show you a slide that shows that this is seriously just a very, very large bounce. So this is the fix, and volatility is what it is, right? When you see spikes like this, it's usually a reaction to something unexpected. The reaction is dealt with, meaning, once again, this just measures the activity on the option side of the S&P 500. It's a pretty good gauge. So a lot of people went out there and did something, and then they sold some calls or bought some puts, whatever it was. But look at how quickly this jumped and how quickly it came back down. We've seen spikes like this since then. Here's a little bit of a slow move back down here in October, but here's another spike, and I believe this was maybe a surprise interest rate, or maybe the CPI was higher than expected. Just tiny little things like that. Now, what we've been seeing recently is not a spike. These are spikes. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. This is a march. This is a march. And what it is, it's a slow increase into fear. Now, don't get me wrong. This could come back down just as fast as it went up. However, when it takes its time to actually climb up to this area, I would expect it actually to slowly move down, meaning that it's not going to be so clear cut as some of these things that we've seen in the past, where it was just kind of a flash in the pan, a one-day announcement that rattled the markets and then was compensated for very quickly. This could be something a little bit more sustainable. So what do we get out of this? Well, just be aware that if you believe the markets have hit a bottom, they might not have. If you can see that maybe this is pulled back to one of these levels, but then starts to climb, I mean, you could chart this just like you can any other chart. It might mean that, hey, you know what? This might be that false bottom. Rob made a great comment of it yesterday, and I wanted to make sure that I carried that forward, folks. False bottoms are very difficult to identify and can cause a lot of pain. So be aware of this might be a little bit longer than one would expect or want to be, right? Okay, so here's the other thing that I thought would be fun. Take a look at what bounced today versus what's been the strongest and weakest over the last little bit. So here's technology, up 1.59%. Take a look at what's on the bottom for the week, down 5%. Technology, okay, communication services, consumer cyclicals. There's consumer cyclicals right at the bottom. Here's communication services right here, down 4.35. So is this the end of the move to the downside? Absolutely not. This is just an oversold bounce on a lot of trades that have been beaten down. And then, on the other side, you've got some stocks that might have been messed with or not. In energy, financials, healthcare, not a lot of reaction. But boy, the ones that are on the top and the bottom, huge movers. And they can account for quite a bit of the movement. So where does that leave us? Well, I'm going to stick with a weekly outlook of 0. This would be easy for me to call it a +1 or 0 because I do expect, and this is just my own personal outlook, I don't know everything, folks. I expect a little bit of a climb up. I do. I imagine we get maybe 1 or 2 days. The CPI number was actually good. Was it caused by something that could be worse? It doesn't matter. For now, we'll see how the market reacts to it. So we'll see if we get 1 or 2 days up. Maybe we do, maybe we don't. We could just get an absolute turnaround and a fall. Now, if we get that, we're going to focus a lot more on this volume because that becomes what we refer to as capitulation. Capitulation has to happen before a bottom can be established. And I really want to echo what Rob was talking about yesterday because here at Maverick, we've seen this a lot. And it does happen. And when it does, it's easily identifiable. But right now, we're not there. Monthly outlook, easily -2. If you're going to make a mistake, make it to the bear side. One thing that I wanted to also do is take a look at this. My potential traits, both gold stocks. FNV is one I talked about last week. I still like it. It's a Canadian gold company. Here's AEM, another gold company, looking really good. But look at the potential bear side. Remember what was the strongest sector today? Qualcomm, Apple, OMC, right? Technology. How about this? Abercrombie and Fitch, Etsy, Airbnb, consumer cyclical. So those were the strongest by far, right? The strongest sector today. But if you take a look at those charts, they're not participating and they're continuing to stay weak. So don't buy into oversold bounces. Just be cautious. I wanted to share some. I don't think you guys need to take these trades. If you don't want to, don't worry about it. Since I took a look at FNV last week, let's take a look at AEM, and it's a very similar pattern. It's this nice kind of ascending triangle or high base, whatever you guys want to call it. Let's call it a high base. It looks very tight. It's very defensive. Lots of worry about the U.S. dollar. Lots of worry about what's going to go on with the economy, tariffs. So here it is. Just wait for it to break out to the outside. All sorts of different things. You don't need to be super aggressive, folks. If you want to do a shorter term +1, -1, I'm okay with that. It's the dink and dunk. Smaller position sizes, shorter term, smaller targets. Get in, get out. So if you want to trade, shorter term, smaller targets, and shorter time frame. If you don't, hey, I'm fine with that as well. Cash is always a good place to be. Let's take a look at the bear that I have. You saw the list. They all look very, very similar. I thought that OMC was pretty cool because it was moving a lot lower, but it wasn't being sold into. It was just being let go. And what do I mean by that? That's just there's no interest in keeping it up. It looks like it had its chance here, a little bit of a spike a few days ago, and the volume has just subsided. It's just rolling over. All right, folks, that's my opinion on some of these things. It is very difficult. There's one thing I wanted to say. If you want to trade something that's showing continued weakness or continued strength, you can do it through an ETF a little bit safer, a little bit slower. Keep an eye out for technical support levels to be established over the next few days, and I'm going to call it an area. It's not going to be a level. There's just too much volatility out there. I imagine we get a gap down at a green candle, we get a gap up and a red candle. I really think we're going to continue to see that volatility as we continue forward. So small positions and or light exposure. It makes total sense here if you guys really want to trade. Please do not build a portfolio. There's no reason to. Even if you do have a bias. CPI lower for February, right? That was last month, but I expect that to continue. It just depends on the activity of the consumer and some of the policies and the carryover from some of the federal layoffs that we're going to see. They will eventually hit here March and April. The PPI and unemployment are tomorrow. We're still in earnings season, if you can believe it. So we got Adobe and American Eagle Outfitter today. And then I saw Dollar General and DocuSign might be kind of interesting to watch. Just be aware it's out there and, make sure you position size correctly if you guys decide to make any trades. Follow your rules and be safe out there. Thanks, folks. We'll talk to you next time. Bye, everybody.